So, good morning, ladies and gentlemen. If I can ask our speakers and guests to convene, and all our friends online who've been patiently waiting. I'm Adam Posen, president of the Peterson Institute for International Economics, and it's my pleasure to welcome back Klaus Regling, who we were just discussing, has not only been, of course, at the forefront of European economic policy making for more than 30 years. He has graciously, every time he's gotten a new job, come here and told us what the challenges are and how he's solving them. More on that in a moment. Welcome to everyone this morning. This is obviously the start of meetings week, so to speak. And we're very proud to once again be doing a joint event with CIGI, the Center for International Governance Innovation from Waterloo, Canada, and the head of the Global Economy Program, Domenico Lombardi. We've managed to do joint events together now through several of the meeting cycles, and will continue to do so, I hope. The Peterson Institute, as many of you know, has been concentrating on Europe and European crisis for some time, and includes some people, notably, of course, Jacob Kierkegaard, Anders Eslund, Fred Bergsten, and others, who have been far more optimistic about the European situation than your median Anglo-American observer. We also, of course, have with us Angel Ubide, Nicholas Veron, Jay Chopra, and now Paulo Moro, a number of other experts who bring their skills to bear, and we are using Klaus's visit to remind everyone that our publication about the way forward for Europe from a macro and structural perspective is available. We also will be later this week holding a host of events with senior policymakers on Europe. Friday morning, bright and early, we will be releasing Anders Eslund's new book on how to fix what went wrong in Ukraine. And importantly, Finance Minister Jaresko will be joining, Ukrainian Finance Minister Jaresko will be joining Anders on our stage. We will have the chair of the Eurogroup with his side job of being Dutch Finance Minister, Jeroen Dijsselbloem, excuse my pronunciation, giving a major lunch speech on Friday. Tomorrow, we will have the new European Commissioner for Competition, Ms. Versteger, who has made a little news in the last couple of days with this sort of Google something or other. I suggest you come here live or watch live tomorrow for what promises to be a very exciting and topical discussion. This just sort of cuts some of the highlights, and we hope you will join us either in person or via the web for these major events. We also have other events, of course, on India, on Latin America, on the global outlook. But today we are here to talk about lessons from the Euro crisis, and we have an outstanding group to do that, and most importantly, we have Klaus Regling. Klaus Regling is the managing director of the European Stability Mechanism. This is, I think, the third or fourth important European institution he's helped create. He is the first managing director. He's also the CEO of the European Financial Stability Facility, which he's been since its creation in June 2010. For 38 years, he's been, as I said, and I mean this sincerely, at the forefront of economic policy making in Europe, going back to the preparations by Germany for the Maastricht Treaty, and then European monetary unification. He spent a decade then with the German Ministry of Finance. From 2001 to 2008, he was Director General of ECFIN, the Economic and Financial Affairs at the European Commission. During that period, we had the pleasure to work with him and many of his colleagues, some of whom are with us here today, and in fruitful collaboration produced a lot of research, which was just a side thing for Klaus, who was busy trying to run Europe at the time. He, of course, has a further background at the IMF in Washington and Jakarta, and so is not just Europe-focused, but right now sits at the core of Europe's response to the crisis, of Europe's response to its partial union, of Europe's response to the best way forward economically. And I'd now like to ask Klaus Regling to give us his views. Thank you very much.
Okay, thanks. Thank you, Adam, for the kind introduction. Indeed, it's a pleasure to be back here at the Peterson Institute, and I like to come from time to time. I followed the Institute actually from the time when Fred Bergson founded it, so it's a long, long history. So the crisis is 6-7 years old, and I think in the past I often talked about our response to the crisis, but now I think we can move a little bit forward and begin to draw lessons from the crisis, what has worked, what has not worked, and what is the unfinished business. And I will try to do that as quickly as possible so that we have enough time for the discussion afterwards. And I'm looking forward to Raza and Domenico to give their views first. So I will talk about the 5 lessons from the crisis that I see. You see it here on the screen. And then I will talk about what to do next. For me, the 5 important lessons are that we have learned countries need to reduce their vulnerabilities because the next crisis will come one day. So those who were prepared better for the last crisis went through the crisis more smoothly. For instance, when I look at the Netherlands and Finland, 2 countries that economically have not done very well. Finland has had a shrinking GDP for the last 3 years, but they were never attacked by the markets. They never lost market access. So I think it's quite not difficult to understand why not. My second point is that we strengthen the governance of the euro area. A lot has happened there. I will talk about that. A stronger European banking system, including banking union, is the third point. An active monetary policy in a crisis is an important element. And the 5th lesson is that we needed a crisis mechanism which didn't exist before. So let me go through those 5 points and then talk about the future. So reducing vulnerabilities, this is happening. We saw particularly the countries that borrowed from EFSF and ESM, but basically all European countries are committed to comply with the Stability and Growth Pact, with a tightened Stability and Growth Pact. One can endlessly debate, and I'm sure we can do that here also, about the speed of the adjustment. But the direction, there's no disagreement. All countries in Europe, in the EU, it goes beyond the euro area, agree to move their fiscal deficits first below 3% of GDP and then run a balanced budget in structural terms. And there's some success. You see on the right-hand side that the aggregate deficit of the euro area is 2.5% of GDP, so about half of what it is in other major economies. And that's also good because it means there's scope to act in case there's another need. I hope it will not come too soon, but if there's a need, Europe has more room for maneuver than the US, Japan, or the UK at the moment. So I think that's an important lesson. Competitiveness has improved massively, but again in the countries that borrowed from the EFSF and ESM. They had lost competitiveness by 2007, 2008. It was a real homegrown element of our crisis. Unfortunately, it became so clear that this homegrown element had become so important at the same time as the global financial crisis hit everybody. So we had the global financial crisis for everybody, plus our homegrown European problems at the same time. And that's important to keep in mind also when we try to understand why it takes a bit longer in Europe to move out of this crisis situation. But the good news is that the countries that had lost competitiveness are restoring it or have almost restored it. That's one reason why current account deficits, which were unsustainably large, 10 to 15, 18% of GDP in 2007, 2008, they have disappeared. Of course, also helped by the reduction in domestic demand, obviously, but countries have improved competitiveness and they are gaining market shares again. But it's not only fiscal and competitiveness, it's also on structural reforms. And when we look at the progress in structural reforms among the European countries, not surprisingly, the countries that borrowed from EFSF, ESM, and IMF, in the context of conditionality, are the reform champions. They are the countries that have implemented more reforms than anybody else. This is what the OECD says. It's very difficult to have an indicator for structural reforms because you have to add apples and pears. But the OECD does it, the World Bank does it, the Lisbon Council does it, World Economic Forum, and they all come to the same conclusion. Greece is actually number one, not only in Europe, but when you look at the OECD area, it's among all the OECD countries. Lisbon Council looks at the EU, and the World Bank looks at all its member states. And again, Greece is a country that has made more progress than any other country in the world during the last 5 years. But here in the World Bank numbers, I think one can very nicely see the problem of Greece. On the one hand, they have jumped 48 positions during the last 5 years, but they are still the lowest ranked country in Europe. I think this describes well their situation. A lot of progress. That's also, I think, why one can be, if it continues, be optimistic about growth, but still, a lot still needs to be done. So that's the first point. What are the countries doing? And they should have done many of these things before, not let competitiveness deteriorate so much, not have such a weak fiscal position. I think that's one important lesson for the future. Second, governance in the euro area, how to improve economic policy coordination. Again, a lot has happened the last few years. The Stability and Growth Pact was tightened. Importantly, less interference is possible from the political side. It's important to understand how the EU works with proposals from the Commission that need to be then endorsed in the Council. Now, with the revised Stability Pact, proposals from the Commission become European law unless there's a qualified majority against that proposal. And that's very difficult to organize by the sinners. If we had had this set up already in 2003, the proposal from the Commission to take Germany and France to the next level in the excessive deficit procedure would have passed the Council. At the time, we needed a qualified majority in favor, and that was much easier to block. Importantly, also, the European fiscal rules are now integrated into national legal systems, which means in the future, when a country breaks a European rule, it will also break its own national rule. So another hurdle. We have a European semester to coordinate earlier fiscal policies in member states. We have country-specific recommendations to every country how to remove obstacles to growth. And importantly, the whole surveillance process has been broadened much beyond the initial focus on the fiscal side. With hindsight, I think it is another lesson. It was a mistake to mainly focus on fiscal. Fiscal plays an important role in the monetary union because the spillover effects can be massive. But we were too narrow. Now we know, and that's a clear lesson, that one also has to monitor regularly what happens to competitiveness, current account balances, credit cycles, and all of that. I remember the debate early last decade when monetary union started, whether we still needed statistics on current account for euro area countries. There were serious people who said we don't need that anymore. Now we know that it was very good to keep those statistics, but we should have paid more attention to them. So another clear lesson. The final point here is Eurostat. Many people are not aware that Eurostat has now a lot more power than before the crisis. They could not go to the countries before the crisis and check the data that were given from the countries to Eurostat. Eurostat could only collect, harmonize the definitions, and publish. And that's why it was possible for Greece to report wrong budget data for a decade. Today, impossible, because Eurostat goes and checks. So another very clear lesson and real progress that this kind of problem, that all of a sudden a country has a deficit of 15% of GDP, cannot happen again. It's just not feasible. Third area to look at is the banking system. Again, a lot has happened, very clear lessons. New institutions have been created already some years ago for the supervision of banking, securities, insurance markets. ESRB, not well known, the European Systemic Risk Board, but with the important task of monitoring macroprudential risks. Another lesson, I think not only in Europe, such institutions did not exist before the crisis. Also the US, the UK have created similar institutions, but they are even more important in the monetary union, because on the macroprudential side, one can adopt country-specific tools, which monetary policy cannot, to fight national credit cycles, real estate bubbles, and things like that. So potentially very important in the monetary union. Financial market reform, Europe, of course, is part of the global debate and decision-making process in Basel and the G20. I will not go into the details, but important to realize that European banks, these are the EU banks, not only Euro area, have basically doubled their capital since 2008. They added 560 billion euro, and that's a doubling. Then the banking union started in November 2014 with a single supervisory mechanism. We have a new bank recovery and resolution directive that will govern the bail-in of bank creditors in the future. There's a single resolution mechanism being built up, single resolution fund, which will be built up over 8 years. At the ESM, we have a new instrument, a direct bank recapitalization instrument. All these are important elements to, again, create a unified banking market in the euro area. It had become very fragmented with negative consequences for the real economy. I think all these measures that have been put in place go a long way to correct that, although we are not at the end. I'm not saying that. It's not everything is in perfect shape, obviously. Monetary policy has played a key role, obviously, during this crisis. The ECB, like other big central banks around the world, had to adopt measures that during normal times would never have been adopted. The ECB actually started early, already in 2007. It was the first central banks that did something when the crisis started emerging. I'm listing here the different things that they have done. OMT was important in September 2012, has not been used, but it's there could have been an effective cooperation between the ECB and the ESM. There are LTRO and TLTRO, quantitative easing, you are all familiar with that, I think. The monthly purchases of 60 billion euro started last month. I think Mario is doing his press conference now, so I appreciate you listening to me and not to him. But I expect that he will just reinforce the messages he has given after the previous meeting when QE was announced. You see here the balance sheet of the ECB, where indeed we see that it reached the peak in 2012, has been declining since, and now the idea is through QE to build it up to previous levels. The fifth point, talking about lessons, is the establishment of crisis mechanism. It didn't exist. The founding fathers of the euro could not imagine that a member state of the euro area could lose market access. It was just unthinkable. Therefore, we never thought, and I include myself, that we would need institutions like this. When we saw in 2010, early 2010, that a Greek package was not enough to return to normal situation, the EFSF was created in May, June 2010. Then in October 2012, the ESM. They have the same instruments, the same mandate and mission. The legal setup is quite different. Also, the capital structure is different. EFSF works with guarantees. ESM works with capital. Both institutions have to go to the markets first before they can make a loan. So very different from the IMF setup. But like the IMF, we only provide financing to countries that accept conditionality in the context of an agreed reform package. During the almost 5 years, these two institutions, EFSF and ESM, have lent to 5 countries. The EFSF to Ireland, Portugal, and Greece, ESM to Spain and Cyprus. 3 of these countries have exited their programs by now. Together, we have disbursed 232 billion euro, which during this period was 2 to 3 times as much as the IMF disbursed globally. And of course, the programs for Greece and Cyprus are ongoing. disbursements are possible, but as always, only if conditionality is met. EFSF and ESM lending has been quite important, as Adam hinted at. Firstly, if the EFSF had not been created, I'm afraid some of our member states would no longer be in the euro area. And I think if that had happened, Europe would be a different place today. But it goes beyond that. Through EFSF, ESM programs, we promoted fiscal adjustment and structural reforms in these countries, as I tried to show in my earlier slides. And that means that these countries will be the most dynamic countries in Europe if they continue their reforms. They will be more dynamic than the rest, which I think is an important second point here. Those, and you do it much more than people in Europe who follow the IMF activities, know that, of course, after countries like Brazil, Turkey, Indonesia went through their painful IMF programs, a few years later, they were the most dynamic countries in the world economy. I expect the same for the countries that bought from us if they continue their reforms. The third point, I think, is still debated a lot, and I'm sure we will get to that, looking at Raza here. Many people think that more needs to be done on the debt side. My argument is that through our favorable lending terms, very low interest rates, very long term, we have created a new framework in Europe that didn't exist before. The starting point was the IMF arrangement, but we have developed it into something unique that provides tremendous benefits to the countries that receive borrowing from us. In this table, we tried to quantify this for the year 2013, and you see that for Greece, which received more financial assistance than anybody else, the benefit in 2013 alone amounts to 8.6 billion euro. This is a benefit for the budget, for the country, and that's equivalent to 4.7% of GDP. It's an enormous benefit. And one has to understand that to see that with continued reforms and continued benefits of this size every year, the country can return to debt sustainability without another haircut. The last advantage of having now EFSF, ESM in the euro area is that we do have a lender of last resort. I think many people in Europe had not realized that that was missing because in a national context, in a crisis, a central bank is not only the lender of last resort for banks, but also for the sovereign. In the euro area, this doesn't work because if the ECB were to play that role, it means shifting risks among countries, and then national governments and parliaments want to get involved. So now we can do this at EFSF, ESM. So quite beneficial to have these institutions, but it took us a while to realize that. So a lot has happened, but the story is not over. There is unfinished business to do, and I will talk about governance and fiscal capacity in this context. I try to be very precise here and identify measures that can be taken without changing the EU treaty, because those who know Europe well understand that changing the treaty takes a long time, is very risky, may not be passed in some countries because it has to be unanimous. 5 or 6 countries need a referendum. And it's just unpredictable if it in the end passes or not. So it's a risky undertaking and takes a lot of political energy to get started. So what I'm talking about does not require the EU treaty change. And the second point that I consider to be important is to find measures that don't lead to further debt mutualization. But I come to that in the context of fiscal capacity. First, on governance, I think there's a realization more and more that our rules-based system, which was crucial at the start of monetary union, is still crucial because with centralized monetary policy, decentralized fiscal and economic policies, rules are essential, otherwise it cannot work. But some of them have now become so complicated that there are not many people left to understand them. Savas is probably the only one here. So there is a problem. And that's why people like Mario Draghi say we need to move to more joint decision-making and stronger institutions and not rely only on rules. we will never abolish the rules, but some have become so complicated that it's better to pass the judgment, let institutions take the judgment. And I think this is important to think about because the incomplete monetary union holds back investment, growth, and employment. So what could be done? Several proposals are on the table. This is not very creative, but you have heard talks about permanent euro area president, a euro area finance minister, not in the sense that all the budgets are pooled, but maybe certain parts of the budget, or somebody who monitors more strictly the commonly agreed rules. Another proposal is to have a fiscal capacity for the euro area. I will say a few words on that in a moment. Joint decision-making for structural reforms, but it also means we need more democratic accountability and legitimacy. All these things are not easy, but I think if one wants to, one can do it without treaty change, even though it is politically and legally not easy. We do have an instrument in the EU treaty called enhanced cooperation that could be used for this purpose. If that is too complicated, one has to move to intergovernmental arrangements, at least for a while, till one day the treaty change may come. More risk sharing is something that's often demanded, particularly by academics, particularly in this country. Not always fully realizing that there is already a lot of risk sharing, more than people realize. Through the EFSF, the ESM, and I gave you the numbers, we dispersed 230 billion euro in 4 years, but also through the EIF, in the future through the Single Resolution Fund. Elements of monetary policy, of course, have some risk sharing in it, target, for instance, but also others. Additional ideas that are under discussion are rainy day funds that could be used during difficult times. Common system of unemployment benefits, different ways to organize it, either give a minimum benefit to everybody out of this fund, which then needs to be commonly financed, or have a fund that only steps in when the unemployment moves above a normal situation in a certain member state, so to help that country if it's, for instance, hit by an asymmetric shock. Targeted fiscal capacity has been discussed to reward structural reforms. And of course, to the extent that we can finalize banking union and capital markets union, this will allow more risk sharing through private channels, through private financial markets. So again, as I said, all this could be organized without treaty change, without debt mutualization, and without permanent transfers. Completing banking union in that context would be good, would be important. There's talk about the capital markets union now. I already mentioned the SRF. There's still the need to have a decision on a backstop for the SRF in 8 years' time at the latest. One could take out old proposals to harmonize, consolidate deposit guarantee schemes, which in a way would complete banking union. And I think it's necessary to think more actively about how to promote private sector deleveraging. This is clearly an area where we have not done as well as other countries, as the US and the UK. Here you see some of the data. One can see that private sector debt in the euro area today is actually higher than it was in 2007, while UK, US, it has fallen. Situation varies a lot country by country, also between private household debt and corporate debt. On the right-hand side, you see, for instance, that household debt on a gross basis is fairly low in Europe. It's the blue line compared to the other countries. So, but the corporate sector, I think, we need to think about it by harmonizing, for instance, insolvency procedures. It takes, in some countries, 1 or 2 years to conclude an insolvency procedure. In other countries, it takes 10 or 12 years. And I think that's an area where we need to spend more time on. I think that would all go a long way to strengthen the resilience of EMU. I don't think we need a fiscal union, a full fiscal union, to make EMU work successfully. But to think about a treaty change has some advantages. As I said, it will take a long time, but one could incorporate intergovernmental agreements into the treaty. ESM could be integrated into the treaty. The single supervisor could be taken out of the ECB, make an independent institution. The Commission, in my view, should become a more political body, which then also means that certain tasks have to be given up, like competition policy. All this clearly difficult, not easy, politically difficult, legally difficult, not terribly urgent if one makes progress on the other things that I mentioned. Let me add here so that we have some time to discuss. Thank you very much.
Thank you very much, Klaus. Of course, there is always this translation issue among friends across the Atlantic. He hears debt mutualization. I hear foolish lenders paying for their moral hazard. But, you know, potato, potato. On that note, it's my great pleasure to welcome back to the Institute Raza Matin. Raza is now Vice Chairman for Global Capital Markets at Morgan Stanley, where he's been for about 6 months. He deals with sovereign debt issues throughout the world in that capacity. But of course, like Klaus, he had a long and distinguished career at the forefront of economic policy, in his case at the IMF. He was director of the European department at the fund from November 11 to July 2014, a particularly good period to be doing that job. Prior to that, he had the more relaxing job of being director of the fund's strategy, policy, and review department for 3 years. He'd worked for the managing director directly under both Dorato and Strauss-Kahn. He worked in the European and Asia Pacific departments, and obviously is as qualified an insider to give a perspective on what the hard choices and the kinds of building, to emphasize, that Klaus has overseen with his colleagues, how much that has made a difference, how much that follows the lessons we want to be followed. So Raza, if you could give us some remarks.
Thank you, Adam, and good to be back in Washington and see so many familiar faces, both from Washington and from the rest of the world. I have not made any prepared remarks, but Klaus has provided a lot of fruit for thought, and maybe I make some reflections based on my experience at the fund and since then on some of the issues that he mentioned. I suppose if I look back at the European crisis or the more generally global crisis, but mainly the European crisis, I think at the beginning of the crisis, what I recall was people trying to come up with solutions, but under 3 constraints. They wanted a solution to the European crisis with 3 constraints: no exit, no bailout, no debt restructuring. That was the initial framework. And 2 of the 3 had to be sacrificed to save the 3rd. And a lot of what Klaus put in place, was part of putting in place, what he described today, was in a way providing a framework for restructuring, providing a framework for bailout, and using those to reform the economies in order to be more competitive. And at the same time, putting in place mechanisms for the crisis to be prevented in the future by addressing the underlying causes of the problem. Some were fiscal, but I think Klaus put his finger on it in terms of competitiveness, the ability to stay in the Eurozone, to be able to be as competitive as the median economy, and close to that, because divergences will not allow you to remain competitive within the zone. And so many of the actions that were taken were in line with those. And I think Europe has made enormous progress when you think that at the beginning, I remember April 2010 or just before that, where the discussion was, no, we could not help Greece, we could not have a financial package because it would be a bailout, it would not be in line with the treaty. And where we are now, not only Klaus is heading two institutions which are in charge of providing financing, the whole infrastructure of the discussions around Europe, around countries, enforcement. Klaus mentioned monitoring and surveillance. There's been a huge improvement in those in terms of putting in place mechanisms on the fiscal and so on. But I think I would like to push a few of the issues where I see where progress has been made, but maybe some of the issues have not yet been addressed in terms of the fundamental problems that we face or the fundamental structures that are there. Let me mention a few. Fiscal rules. It is certainly the case that there is now an elaborate system of assessing, making sure countries' fiscal budgets are in line with an overall understanding. But the question to me is, do the rules themselves make sense as they are? What has happened in Europe throughout the crisis is recognizing that the rules are imperfect, trying to amend them to provide flexibility, and at the same time making them more complex. So I think, Klaus, you mentioned not many people are there, perhaps Servas here, who can explain to us whether or not Italy currently meets the rules. So there is a constructive ambiguity, but the question is, do the rules make sense in terms of what you need to achieve? So does the overall 3% target still make sense? Now, it has been supplemented with structural balances, with debt reduction targets in a fairly complicated system where you have to reduce a little bit of your debt if you're above a certain level. These are not easy to explain. Not only they're not easy to explain, they, in my view, sometimes they undermine the political support, social support for these rules, because they are complicated to tell people whether or not a country meets. And I completely agree with some of the issues that Klaus mentioned in terms of centralization, greater central budgets, more decision-making in groupings by European finance ministers, possibly Euro finance minister appointment as a permanent feature, and what you said in terms of political support. But political support also needs rules that are easy to explain and for people to connect to. So a little bit more on the fiscal. So very difficult to understand why everybody, irrespective of where the debt level or the economic level is, needs to be bound by the 3%, by the minus 0.5% structural deficit. I think it makes much more sense to be able to differentiate based on the level of debt and where countries need to be, and therefore determine the speed of adjustment. Now, you could say that exists in the current framework, but it's bloody difficult to get at it in a very simple, transparent way. So that on the fiscal front. Banking. I think I completely agree with Klaus. I was surprised during the process in 2011, 2012, and 13 how quick Europe was to recognize that banking union was needed. I remember being at meetings in early 2012, I think it was, and the concept of banking union was alien to many people in the policy meetings. And The crisis was an impetus, but the logic of why it needed to be done was also persuasive. It was also an easy, going back to explaining to the public, it was an easy narrative to explain to the public why it was necessary and why it made sense. And so I was pleasantly surprised how quickly Europe moved to put that in place. And if you look at key initiatives in the last 3-4 years, I will put that pretty much near the top of the list. And the associated asset quality review, which was done with that, and the comprehensive assessment, I think was very important, very late in the game if you look at it compared to what the US did, but incredibly important. By the time this was done, I was in the markets, and the market perception of the importance of this was quite striking to me. So it was very important. The issue to me, again, to try and push the envelope further on this issue, the issue to me is whether they were strong enough in terms of what came out of the asset quality review and what to do about it, even if they were not ever strong enough. When you see what has happened to European assets, European shares, partly in response to quantitative easing, have been surging ahead, but that has not been the case with the banking system, despite the improvement before asset quality review. So that is a question mark. Why is that? And what can be done about it? I think this is, to me, an incredibly important issue. And since I've been to the markets, I've become much more convinced that this is a key for the European economy to accelerate its growth. And let me give you a few examples. What am I proposing? I think what needs to happen is for the European supervisors, SSM, the individual supervisors, to be much more aggressive in terms of forcing banks to get the bad assets out of their books. Now, there are ideas of central bad banks and solving it on your balance sheet and so on. I've come to the conclusion, since I've seen some of this in practice over the last 6 months, that the best way to generate economic growth and recovery is to actually push those assets out of the banks to be resolved. I give you a couple of examples of what I've seen in the markets. Ireland. Ireland started this process about 18 months ago, and they were initially reluctant to put things on the market, and they were reluctant because they thought the prices were too low, and they were. They were definitely underpriced in the markets initially. They started putting it on the market at prices of something around just under 30 cents to the dollar in the first tranche. By the time they were done, the last tranches were sold for about 90 cents to the dollar. And most interestingly, this is not being fire sales and being market people trying to get hold of cheap assets. It's quite different. Specialist firms looking at this, very large firms looking at this, and assessing the quality of the assets and being able to negotiate directly with the borrowers. And what was interesting to me, when this process happened in Ireland, actually some of the loans ended up being back in the banks. Those who resolved it put it back in the banks. Because that was where the relationship was. They took their profit. They were able to give a haircut. They were able to assess whether or not you needed to resolve the assets. And another very interesting thing, most of the assets were not actually foreclosed. Foreclosure was necessary as a threat. Most of the assets were resolved, were made good assets. They were not foreclosed. They were put back on the banks. And the same thing, to some extent, is happening in Spain, following some of the changes that they have made in the regulatory framework. So to me, this is another issue, important issue going forward in terms of accelerating. Now, there has been the AQR. In theory, the capital of the banks should be adequate. This process will make sure whether it is adequate or not, but more importantly, it would initiate a process where you have recovery, activity, and growth back in the economies. And I can tell you from where I sit right now in a bank, the countries which are doing this, there's definitely a greater degree of activity, definitely higher growth. Now, another issue which perhaps I was reminded of when Klaus was talking. If I look back at the crisis management over the last 5 years, I would say there was one overriding issue which we as technocrats and even politicians did not pay sufficient attention to. What I'm always impressed by is the solidarity within Europe. It's a messy process. It's a difficult process. We have continuously meetings which don't get anywhere, but there is a degree of solidarity among Europeans that in most of the cases, let's say 17 out of 18 cases, has led to a solution. But there is one issue which has always puzzled me, and that is there is often inadequate, while each of the politicians think about their constituency and back home, there is often inadequate attention to how measures would be perceived socially and in terms of social sustainability going down the road. And I think, there are a lot of problems in Greece, but that is one of them. We did not think adequately about the scale of the problem and what that means in terms of the impact on the society and the political outcome. It matters at the end of the day. And so, while the scale of the challenge is very high and what needs to be done very high, the European solidarity, which has been there almost everywhere, needs to play a role in terms of how you adjust socially and what the political impact is. And this is not an easy issue, and it's not an easy issue to go across borders. But looking back, and I am as guilty as anybody, I think it is an issue where I certainly, when I was at the fund, I don't think I paid adequate attention to it. But let me just finish, Adam, I know we're running out of time, with a few words on Greece, because Klaus talked about many of the positive things that have happened in Europe, and I agree almost entirely with what he said and his focus on the measures and his forward-looking focus. But Europe also needs a solution to Greece. And I am somewhat, I'm getting depressed just reading about what is happening, not being involved, because there is this sense of fatalism. There is a sense of blame, there is a sense of fatalism. My hope is that spirit of solidarity that I've seen in Europe will overcome this. But the Eurozone is the adult in this process. And what I find disappointing is certainly the way the new Greek government has been unable to put credible strategy forward and unable to engage and unable to understand the severity of the situation. But I think we also need to look on Europe, because Europe has done this many times for other countries, including for Greece. And so I still think it is not too late, although when you talk to people, everybody has this sense of fatalism. it is possible, taking into account what has happened there politically, what is happening there socially, to put into place or ask for a limited set of important things and really test the government whether or not they are able to do it. A limited, not a 26-page document, a limited 1 page of actions. If they cannot do it, okay, that's the end of the road. But I do feel that a strategy right now is missing, and an accident there, I sit in the markets. Markets are incredibly positive about Europe right now, whether you talk about equities, whether you talk about fixed income. But believe me, most of that has got to do with QE. You have a huge purchaser of assets in the market, and QE has had a huge effect. It will continue to have, and it's a very good safety net. But it is not because people believe that the European growth prospects have improved and confidence has improved. These things are very fragile. Thank you.
Thank you very much for that multifaceted set of comments on the fly, Raza. You are, of course, steeped in this, and you are right, I fully believe, to be picking up Klaus's forward-looking emphasis on what's been built in Europe. I would just suggest, in terms of the growth prospects for Europe, you might look at our presentation of the Global Outlook last Tuesday, in which Jacob Kierkegaard made a strong case that there is real reason that a well-capitalized banking system, as you and Klaus both pointed to, interacting with QE, following the AQR, provides an additional floor, among other things. I'd now like to turn to Domenico Lombardi for a slightly more outside perspective. Domenico, of course, is well known to many of us here in Washington and around the world. He is the director of the Center for International Governance Innovation, our friends at CIGI's Global Economy Program, the founding director. It doesn't sound quite as good as being the man who founded the EFSF like Klaus, but it's good. And of course, has had distinguished tenure at the IMF and the World Bank. He also serves as chair of the Oxford Institute for Economic Policy, in Bretton Woods Committee. He's a member of their advisory board. He's an advisor with us and partners with us, and would like to hear his take on governance going forward in Europe.
So thank you very much. Thanks, Adam, for putting this together. This has become a tradition for both CIGI and Peterson on the eve of the annual and the spring meetings. And it's always a pleasure to be back here in Washington. Also, let me reiterate that at CIGI, we're very pleased with the partnership with your institution, Adam, and we look forward to further ways to enhancing and nurturing it. Let me come to today's topic. What I'm going to do is first to react to some of Klaus's comments and his presentation, but I'm also going to draw on some research that I've been doing at CIGI. CIGI focuses on global issues, and certainly the Eurozone is an important topic in that respect. And the research I'm going to draw from is a joint research that I've done with my CIGI colleague, Samantha Santamandus, sitting back there. So I think one way of summarizing what Klaus has said is that there has been progress at both the policy level and at the institutional level. But what I would add is that this convergence process is also far from complete. And of course, the sustainability of this convergence process is still at least partly uncertain. And I'm going to go through a number of points, and I will, as I said, complement in many respects what Klaus has been saying in his presentation. So if we look, for instance, at macroeconomic imbalances, we do see, and we focus our attention to intra-Eurozone goods trade. we see that some of these imbalances have reduced to a greater extent. Of course, at the current account level, this is less evident, or as Klaus indicated, actually the adjustment has been working mainly through the debtor side. In fact, yesterday the IMF's WIO released the new numbers, and I was looking at the current account on Germany. Well, it has increased from last year, and right now it is projected for the current year at 8.4%. Clearly, the adjustment in that regard from the southern economies is something well taken. It is also true that these economies are not at full potential, and therefore, we shouldn't overemphasize this apparent convergence. In terms of ULC, we see some convergence. We see convergence in a number of countries from the periphery, partly because Germany is helping in that regard, partly because these countries, for instance, Greece or Portugal, have been introducing measures that have facilitated that convergence. There are still some exceptions. Italy, in particular, is a big outlier if you look at ULC dynamics, and therefore, this is something worth noting. In terms of the regulatory environment, we also see some convergence, and partly this is due to the fact that, again, some of the periphery economies have been implementing a number of structural reforms in the context of the Troika programs, and therefore their ranking in some of the leading services has been lifted up. Again, Klaus referred to that. And what is also evident is that not just the lower performers have been improving on their ranking in, say, for instance, the ease of doing business survey conducted by the World Bank, but also the range between the top performers and the lower performers has been reducing. And also the dispersion in the various Eurozone economies has also been reduced by a number of metrics that you can use to assess relative dispersion. So this is certainly a welcome development. In terms of the institutional developments, let me focus. I think Klaus referred to broader institutional developments. I want to flag a couple of points on the ESM itself, and I've been studying regional and plurilateral financial arrangements and comparing them to among themselves as well as vis-a-vis the IMF. Clearly, the ESM has a number of novel institutional features. It can provide direct recapitalizations to financial institutions, can intervene in primary and secondary markets, and it can borrow from financial markets. However, the size, the lending capacity of the ESM, especially if we want to benchmark it or assess it as a lender of last resort for sovereigns, well, then the lending capacity of the ESM is still relatively limited, currently standing at 500 billion euros. And in a way, this limits its effectiveness in functioning as a lender of last resort if larger peripheral economies, say such as like Italy or Spain, were to run into difficulties. So this is one point I'd like to stress. And then the second is, I was, of course, looking at Klaus' presentation, Klaus' slides on the banking union and the improved regulatory framework. As we all know, there is a bail-in provision for investors. But then I see a slight tension between, on the one hand, introducing the bail-in provision for investors in the context of the banking union, but then on the other, leaving a little bit outside of the box the issue of an orderly sovereign debt restructuring for Eurozone economies. And clearly, if your financing capacity is not large enough, of course, you may want to consider a framework where crisis resolution can be more orderly and where there can be more predictability. Maybe acting on its own, this is not the right strategy moving forward, but I was a little bit surprised to see that when in September there was a debate within the General Assembly of the United Nations towards the resolution for an orderly and comprehensive framework, some key European countries, for instance, voted against. And therefore, what I'm suggesting is that this is still a missing piece in the European governance, especially because the Eurozone is a monetary union, but it is clearly not a federal union in the same way the US is. And therefore, if the ECB cannot act as a lender of last resort, unlimited lender of last resort, if the ESM's financial capacity is constrained at such a level that might compromise its ability to work with the larger sovereigns of the euro area, then I would argue you do need a framework that correct for this gap. And I believe this is also something Raza was hinting at when he was recalling the impossible triangle at the height of the Eurozone crisis. This could be done, as I said, in the context of the European process, but of course there are other international fora. The UN is one of them, the IMF is another one, or the G20. So there are a plurality of fora in which this debate could be revamped and could be supported. And I think the Eurozone would greatly benefit exactly for the reasons that we have been discussing here this morning. So I'm going to stop here, Adam. Thank you very much. And again, thanks for putting this together.
If I could ask our Klaus and our two discussants to come up on stage, and let's put Klaus in the middle, at the center of things, and ask you to attach a microphone. This allows me to have the commercial break to advertise the Peterson Institute. Of course, as I mentioned earlier, under leadership of Angel Ubide, we earlier released a study, Rebuilding Europe's Common Future, combining growth and reform in the euro area, with contributions by Jay Chopra, Nicholas Veron, Jacob Kierkegaard, Paulo Maro, and Angel. And this, in a sense, I urge you to read as a complement to what Klaus was talking about, and may push in some different ways. I also just want to pick up on something that Domenico just said, which is the issue of debt restructuring, which of course is critical potentially for Europe, within the euro, but also, of course, for Ukraine, for Argentina. Some of you may recall, and I'll refer you on the website to an interesting event we held here about 3 weeks ago with Seth Hagen from the IMF, with some colleagues from McKinsey, and in particular featuring the analysis of our colleague Anna Gelpern, who's been doing groundbreaking work on this, and I hope you'll take a look. But now that our colleagues are seated and mic'd, I will just first ask Klaus if there's anything particular he briefly wants to respond to from either Raza or Domenico, knowing that Klaus does occasionally like to respond to things.
Because occasionally I don't agree. That's maybe on the point you also just picked up, and it is an important aspect. It's discussed widely. Do we need a sovereign debt restructuring mechanism in the euro area? In my view, no. Countries in the euro area are not like Argentina or Ukraine. They benefit from the solidarity that Raza talked about, you talked about. I showed some numbers that through our favorable lending terms, very low interest rates, very long-term maturities. For Greece, I didn't mention earlier, we even have a deferral of the interest obligations during the first 10 years. There's a lot of solidarity, adding up in the case of Greece to 4.5% of GDP annually. So that will help the countries that have, or that seem to have, unsustainable debt levels now. That's the conclusion that people sometimes have when they only look at the debt to GDP ratio, which is inadequate. Because you can have a very high debt to GDP ratio. Look at Japan, when the associated debt service is relatively low. And we have created a system in Europe that makes that possible. And then together with the rules of the Stability and Growth Pact, where Raza thinks we should refine it and make it even better. But overall, as I said, there's no disagreement that for a number of reasons, we want to move not to deficits of 3%. That's a secondary rule. The main rule is balanced budgets in structural terms, which means the deficit, of course, can fluctuate with the cycle. But given the high debt levels and the unfavorable demographics in Europe, this is a consensus view. And so if we follow these rules, and for those cases that are very difficult now, like Greece, we have our lending in place. I don't see why we need then in the future sovereign debt restructuring mechanism. It will not be needed in the euro area. It may be needed for some other countries. Maybe I'll leave it at that.
Thank you very much, Klaus. So we are on the record. I'm going to open it up for questions and comments. Jessica has a moving mic here up front. Others can go to the back mic where they can be recognized. So first, why don't we start here with this gentleman? If you could identify yourself and pretend you're asking a question rather than making a statement.
Thank you, Malcolm Knight, CIGI and the London School of Economics. I have a question for Klaus, but maybe for the other commentators as well. I don't think any of you mentioned, or only mentioned en passant, the single resolution mechanism. And it seems to me that that's quite an important element in principle in mitigating the risk of too big to fail in Europe, particularly in a situation where going forward, the banks in Europe look like with their current business model are going to have a relatively low return on capital. So there are going to be huge structural changes here. How important is this single resolution mechanism, and what's needed to, if anything, to make sure that it actually will work when it's needed?
No,
respond?
I assume you guys can take care of yourselves,
Okay.
please.
I don't know whether you want to collect
Sorry.
questions, but I'm happy to make some remarks and others will step in. I think it's a key element of the banking union, absolutely. Without the single the SRF, it wouldn't work because one needs to be prepared for the adjustments. Europe is overbanked, as the IMF always points out. So there will be some structural changes. To have an SRF is key. Some people have said it's too small. Others are critical that it takes 8 years to build it up. But this is the good European tradition to start slowly. If in a few years we come to the conclusion it's too small, I'm sure it will be possible to beef it up. It's important to get started. It's also important because it adds to risk sharing in the euro area, because this is really a mutualized pot of money that will be available eventually, fed by all the participating banks. As I said earlier, what's still missing is to have a backstop. Like in the US, the US Treasury provides this backstop. It's always in the national context easier to organize this than in a monetary union with 19 countries. But we will get to that point. There's clearly the intention of the euro area to return to this question. It was marked as to be resolved during the build-up phase of the SRF. So I can only share your view. It's really a key thing.
Raza, you're in banks at the moment. What do you think?
No, I think this is another area where there has been a major evolution in Europe. I think seeing Jay stand up there reminds me of the debate we had about the senior debt in Ireland. The debates we had on how to manage the resolution of banks in Cyprus and the final bail-in. And I think the single resolution mechanism is in a way a conclusion of all those debates, recognition that you need mechanisms in order to deal with hopefully rare circumstances, that you need rules of the game so that the private sector, the banking sector, and borrowers and lenders are aware of they have the right incentive structure. So I think it's important from all those perspectives. Maybe I comment also on the debt restructuring issue. Small. Look, debt restructuring is a fact of life in the world. Economies get into trouble. Almost doesn't matter what level of debt. You can think of many countries from different levels of debt have got into. So you need a mechanism. The same way you need to resolve banks, you need a mechanism to resolve unsustainable debt in countries.
That was nice and short. Domenico, I want to go to more questions. Do you have anything short on the debt restructuring issue?
Well, clearly there are different views whether Eurozone economies might need or benefit of a sovereign debt restructuring mechanism. My point is that regardless of the view you hold, still the Eurozone is an important stakeholder at the international level, and as such should be promoting a better debt architecture at the international level, which may or may not be triggered or benefit any of its economies at the time of the next crisis, and regardless of that.
Great. Jay, and then here. Could you say who you are, please?
Jay Chopra from the Peterson Institute. I want to pick up on the discussion of fiscal rules and ask a question about the aggregate fiscal stance of the euro area. These fiscal rules apply for individual countries. And there tends to be a bottom-up approach where you aggregate these countries and you end up with a fiscal stance for the euro area. But the individual countries in the eurozone are small, open economies. The Eurozone as a whole is a large closed economy, and its fiscal requirements might be different. Now, are there possible mechanisms to come to an appropriate fiscal stance for the euro area as a large closed economy that doesn't rely on this bottom-up approach and doesn't necessarily rely on a fiscal union?
Thank you. Klaus?
We don't have such a mechanism in place. We are busy enough going through this transition period coming from high deficits, which we have to remember were decided, it was a deliberate decision after Lehman in the context of the G20 to have fiscal stimulus. And that was one reason why the deficit shot up. So it was a discretionary fiscal action at the time. So in a way that was a decision that had to be taken at the national level, because only the national parliaments can adopt such measures. But it also added up to an overall fiscal stimulus for the euro area as a whole. So, but this was really the exception. Now we are in the transition period from these high deficits to get to a situation where every country complies with the Stability and Growth Pact. This is a difficult period. It's not over, but my chart earlier on shows that we have been making good progress, and there's no disagreement about the direction. Countries will move to a balanced budget. If something really exceptional happens, like in 2008, 2009, we have seen that within the fiscal framework we have in Europe, a lot can be done. But I consider that to be really exceptional. Well, you know me, I'm normally not in favor of fiscal activism. But in late 2008, I was very much advocating fiscal action. But for me, that was the first and so far only time in my professional life that I was in favor. It was a very clear-cut case. So if that happens again, yes. But as a regular feature, I don't see the need.
It's interesting, I'll just note, in part with support won through open competition from DG ECFIN, we did a book on the future of the euro in 2005, and one of the chapters in there raised the issue that there was insufficient fiscal activism in the euro area, and this was part of the problem. But of course, it also related to something Klaus said in his initial remarks that he was definitely principled on, which was the, I'm allowed to say, hypocrisy of letting France and Germany get away with their violations of the budget rules in the early 2000s when they were applied to other countries. Hung, and then at the mic.
Well, thank you. Hung Tran from the IIF. My question is to Klaus, but I would like to hear Raza's and Domenico's view as well. Question is, given the improvement in policy term and institutional improvement, particularly for crisis management and resolution in Europe, does Europe need the IMF anymore? Particularly one, as you said, the resources that the fund can bring to any European country in crisis is very small and dwarfed by the resources of ESM, EFSF, and the Euro group. Second, the resources from the fund is very costly, short-term, not at all suitable for countries in that sustainability crisis. And number three, the technical expertise that the fund used to enjoy. I think that ESM, yourself, ECB, Commission, ECFIN, staff have picked up a huge amount of experience over the past 7 years. So in short, why don't you change your name from ESM to EMF and be done with it?
You're right, the situation has changed greatly. I think 5-6 years ago, the IMF was really needed. Initially, also, the IMF provided 1/3 of the financing. Now, for the second Greek package and for Cyprus, it's only 1/10. The rest is coming from EFSF and ESM. The expertise has indeed been developed greatly at DG ECFIN. So initially, the IMF was really needed, and that's much appreciated. But to go as far and say we will never need the IMF again, I don't support that, because European countries are members of the IMF. And IMF membership brings certain obligations, like providing information, participating in surveillance and Article 4 consultation, and certain rights. The right is to draw on IMF resources in a crisis. Why should European countries say once and for all, we want to give up this right unilaterally? I don't see a need for that. It may mean that if 20 years from now there's another crisis, that it can be handled in Europe, but I would not ex ante give up this right. This question of European Monetary Fund always comes up. People always try to tease me with that. We have a different setup in Europe, in a very traditional European sense. We like decentralization. We have different players. We have the Commission. I don't want to recruit 200 economists and do the same work that my former colleagues do in Brussels. I could probably do it, but why have this overlap? It's costly. So the Commission is there. The ECB supports the process. This division of labor is working. So to put it all in one house, like at the IMF in Washington, where they do it rightly in that way globally, there's no need in Europe.
Well, let's mix up the order. Domenico and then Raza.
Yeah, so I would say that the Eurozone still needs the IMF for at least a couple of reasons. So the first reason is that it's true that the ESM has been set up. There's a number of fire nets or firewalls, but these are regional arrangements, and regional arrangements also entails regional proximity. This is why historically sometimes it may be beneficial to outsource conditionality or the monitoring of conditionality to a third sort of more independent party that is located outside the region. And this has happened in the past in other regions, as I said. The second reason is that the ESM has a certain financial capacity. As I hinted before, that might be limited. It depends really on the problem at hand, and therefore the IMF does provide an important option for scaling up assistance in that regard. And so I would say, for these two reasons, we may still expect the Eurozone to rely on the IMF in some fashion.
Raza.
Thanks. The question is, in what role are we talking about? The fund has traditionally had very good surveillance relationship with the Eurozone, with individual countries, but also with the zone as a whole. There is a Eurozone Article 4. And I think that is an incredibly good process. It's an important process, not just for Europe, but also for the rest of the world, in terms of having independent views of the fund about what is happening in individual countries, but also in the Eurozone as a whole. So I think that's an excellent process, and that is separate from the IMF's dealing with the crisis. Is there a need for the IMF financing at this point in time? No. Can you rule out IMF financing in the future in Eurozone? One should not, for precisely the reasons that Klaus has mentioned. More specifically, you can talk about Greece. Is the financing needed by the fund in Greece? I don't think so. It doesn't. Greece needs long-term financing. In my view, it also needs a solution to its debt. Long-term financing should not be the role of the fund. The fund financing is expensive precisely because it's a balance of payments, short-term financing.
Great. I'm going to ask the two people at the back mic to each give their question to make sure we get them in as we're coming to the end of our time. Please.
I'm Raza Matin from the University of Spain. I have a question for Klaus. The first is, why do you think that corporate debt in the euro area should come down when we badly need corporate investment? The second is about the OMT that you rank among the other measures. In my view, there's a before and after the OMT in the euro crisis. And the question is, why did it take so long for the OMT to arrive? Thank you.
Do I see Georges Pinot or another ECB rep here to deal with that? No, sorry. Go ahead. Yeah, actually it does.
It does? Okay. Georges Pinot from EBRD. Quick question to both Raza and Klaus on labor market mobility. This is one area that has not been mentioned, and this is one area where one feels that actually there has been not simply no progress, but a regression relative to what we have had before the crisis. Even countries like the UK, which was open to labor market mobility, is now closing down increasingly. And that, of course, basically blocks an important equalizing mechanism in the Eurozone and in the EU in general for future European integration. And that also shows that there is a political disconnect between the strong European solidarity, as Raza said, and the national feelings, the national electorate feelings against more Europeization. I live in London, maybe I'm biased, but one feels on an everyday basis a backlash against labor market mobility, again, going against further European integration.
Question mark. So Klaus, on the first point from the gentleman from Spain, you don't have to defend the ECB.
No, I have no problem defending the ECB normally.
Oh, I do, but okay.
But that's the difference, maybe.
Yes.
The dilemma is there. You described it. You said, why should corporate debt, why should it come down? We want to see more lending. I think we need to see both. And Spain is not a bad example. We need to, or banks need to take care of their NPLs, as was also said by my colleagues here, in order to create room so that they can do normal lending again. It's tricky. It's part of this difficult transition period, but that's what we need to see at the same time. Maybe I keep it short here. OMT, well, I was happy when it arrived in August 2012. It was very important at that moment. I'm also happy it has not been needed to be implemented. The announcement contributed greatly to calm down markets. We would have been prepared with the ECB to implement it. I signed an MOU with Mario Draghi on how to do it, the cooperation between ESM and ECB. But it was not needed, so that's perfect. We like to have instruments available for crisis management and then not use them. The IMF does the same thing. So that's very good. On labor market mobility, I wonder whether you're a little bit too influenced by where you live in the UK, I assume, which is really quite different from what I see in the euro area, where I see a lot more labor mobility in the crisis. Certainly people are moving from the periphery to core countries much more than ever before the crisis. I happen to have a German passport, as you probably know. although I haven't lived there for 20 years. But I know that big German companies like Bosch, Siemens send recruiting missions to Spain to get people because the German labor market is so tight. So this is ongoing, supported by the government. It's happening. And you see it in the numbers in a striking way that is not often noticed in the media. Germany, until 2010, so let's say till the crisis started, had a decline in its overall population every year of 200,000 to 300,000. Since 2011, Germany is growing again by 300,000 to 400,000 people a year. So this is a swing of 600,000 to 700,000 people. This is like 0.8% of the population. It's amazing. It's a tremendous swing.
Sorry, Klaus, just to be clear, since you're quoting specific numbers, are you talking about growth in residents within German borders, or are you talking growth in German citizens here?
In residents.
Thank you.
So this is only explainable through the crisis because the birth rate has not moved. It's low even by European standards. So the crisis has actually led to significant more labor mobility than we have seen in a long time in Europe. On top of that, you have the very clear trend that among academics through the Erasmus program, people who study at universities and then find jobs somewhere in Europe, a lot more mobility than before. So to describe all this as a general decline in labor mobility in the euro area is just wrong.
Okay. We're at our witching hour. Do Raza or Domenico have anything particular? No?
Nothing particular, I think, on this side.
Yeah, and Klaus, I think, deservedly gets the last word. Thank you all for joining us for the start of the exciting season. We know there are many events, including apparently a particularly lively press conference for Mr. Draghi in Frankfurt. But we're very glad to have you with us today. I'm grateful to CIGI and to Domenico Lombardi for joining us in supporting this effort. I'm very grateful to Raza Matin for his first appearance on the stage since he left the fund. And in particular, I'm grateful to Klaus Regling for choosing us as a venue to talk about building Europe's future, just as he has been so critical in building Europe's past and present. So thank you very much.